Hello, everyone. Happy Monday. Welcome to the final bar. We're going to talk about the S&P's continued deterioration to the downside. The Nasdaq really leading the way lower, down over 2%. But energy, the weakest of the 11 S&P sectors, as oil prices come off. Energy struggling as well. Today's Monday, so we're going to hit the market from three directions: top-down macro, weakness in stocks, weakness in gold and other commodities, bonds as well. We'll talk about sector rotation, and we'll finish with some individual names you should follow. Ladies and gentlemen, this is the final bar. Hi there. Welcome to the final bar. This is Dave Keller here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market environment using the power of stock charts, using the technical toolkit to try to understand this current market environment. It's been an uncertain day among many uncertain days. The S&P really pushing to the downside through the bulk of the day, sort of settled in below 4,200 going into the close, but the damage was really done. A lot of equities sort of in risk off mode. But about half the S&P sectors were up today. But it's probably not the things you want to see if you are bullish on the market. It's more defensive stuff, more things that tend to be bear market leadership, things like healthcare, consumer staples, utilities, all in the top half of the list. We've talked about the S&P 500, some of the key levels to pay attention to. We're going to update that look today as we look at the S&P closing back below 4,200. What levels to pay attention to? We're also going to talk about some of the other asset classes as well. So you have commodities really rolling over here in the last week. Oil prices coming off, and oil obviously ripped to the upside given the uncertainty in Ukraine and in Russia with Europe with the U.S. Now all of a sudden coming back down as there's implications of potentially oil prices being overheated to the upside and maybe supply starting to meet the demand that we have. But also we'll look at some of the other themes as well, particularly with sectors. When we talk about leadership, which stocks tend to lead and which tend to lag during different parts of the market cycle. If the market has topped off and we're really starting to roll over, you're going to start to see the signs with the equity sector leadership. And we arguably say we're seeing those sort of trends now. We have great guests on the show. I'm excited to welcome these three to our show in the coming days. Tomorrow on the 15th, we have Samantha Leduc from Leduc Trading. On Wednesday, March 16th, we have Bob Lang from Explosive Options. On Thursday, the 17th, Clint Cowles, who's a strategist at TD Ameritrade, coming to us from Minneapolis. Also coming up next week, we will be doing Chart Madness. That is a stock picking exercise with myself, Grayson Rose, Greg Schnell, Tom Boley. We actually picked a field of 16 stocks. We went with the largest 16 names in the U.S. We're going to pick a bracket, pick our potential winners, our final four, and our champions, looking out about 5 to 6 months down the road. You can actually print out your bracket now if you go to stockcharts.com/chartmadness. You can print out your bracket, fill out your picks. We will share ours on that special coming up next week on the 24th. Let's continue on with our market recap. We'll talk about the big picture here to start out with. The S&P down about 0.75%, closing back below 4,200. Now, Friday's session, we closed right down to 4,200, which has been a significant level we've talked about many times, the key Fibonacci level going back to September of 2020. So we'll look at what this breakdown, this close below 4,200 really means for the S&P. The Nasdaq over twice as negative of a move percentage-wise, down over 2%. The VIX is actually pushing back higher, so remaining above 30, which is a fairly elevated level relative to where it had been for the year prior. A lot of movement in asset allocation today. So you had bond prices coming off pretty significantly, with a 10-year yield getting above 210, finishing the day around 214, which is a new high for the year. Dollar index essentially flat for the day. Commodities all moving to the downside, and energy prices down pretty significantly. The USO finished down about just under 5%. The energy sector was the worst performing of the 11, down about 3% for the day. But it wasn't just crude oil prices, it was everything. Soft commodities, metals like gold and silver, both down over 1.5% to 2%. Cryptocurrency is actually one of the few spots on the market with green today. Would be cryptos, all top 10 most liquid coins that we track, all positive for the day. If you look, actually, really gapped down earlier today, but came back and really settled into where Bitcoin has spent much of the last day. So, really, not a lot of deterioration there, not a huge recovery, sort of back to where it was, settling in just below 39,000, and Ether just above 2,500. Let's look at a chart of the S&P 500 to continue this macro discussion. So here's the concern I have when we start closing below 4,200. That is obviously the low from back here in January. That was the closing low here in late February. Even though we opened that next day lower, we closed back above. So on a closing basis, it was around 42.25 was the low from late February. We closed right at 4,200 a couple times. We actually undercut today's close by just a little bit last week. And so we're really pushing the lower end of this range. And what this does is, as long as we continue here, is continues this pattern of lower highs and to lower lows. I'm struck with some of the conversations I've had with my guests in recent weeks where we've talked about the S&P trend. And for the most part, we've all sort of been in agreement. You take a step back from your monitor, you just look at the overall trend, look at how the configuration of this market has changed from the left half of this chart to the right, really right quarter of this chart, right? This sort of that, a big change of character in this market starting in January. Now, again, what's interesting is we've talked about a lot of the breadth and momentum shifts occurred in November. So a lot of things actually peaked in November, even though the S&P, the Nasdaq, pushed higher, and the S&P made a higher high, just above 4,800. The negative sense that you got from breadth and momentum was fairly well established at that point, and now we're just in a downtrend. Now, what happens when we close below 4,200? I would argue that opens the way to further support. Now, if you look at these levels, taking the September 2020 low, the 50% retracement would be just above 4,000. Now, often big round numbers like 4,000, 3,000, 1,000 often serve as significant levels that, regardless of what is going on, you'd at the very least expect to bounce there. So the fact that there's a 50% retracement level right at 4,000, which would be a big round number where a lot of investors will key in on, is the S&P going to undercut that, and go below 4,000 for the first time since early 2021? And that's why you get at the very least a bounce. There were some people assuming that it won't. If it does, and I think the likely scenario is we continue lower to test what could be the ultimate low, or at least a downside objective around 3,800. That's a 61.8% retracement of September 2020 to January 22, and that's why I think that's a key level to pay attention to. But first things first, we have to be undercutting support. We're seeing yet another close below 4,200. We've only done this once before. The immediate next day, we rallied back to erase that breakdown. Do we get the follow through today? Into tomorrow? Do we get a validation of this close below 4,200? That's the open question. Now, of course, we're talking this week where we're going right into the Fed meeting, and this is most likely the first of a number of rate hikes that we experience over the next couple years. Here's what the situation looks like. Interest rates pushing to the upside today, with bond prices coming down fairly significantly. The 10-year yield settled in right around 2% on Thursday and Friday of last year. Today, gapping higher, finishing the day around 214. If we look at bond prices, so we could use the TLT, for example, you can see that the TLT is actually testing the lows for the last couple years. We're actually back down to the March 2021 low in bond prices, again, using the TLT. I'll remind you what I've reminded people many times. Never confuse the bottom of the page with support. So if we get too excited about, all right, great, we're at the lows, we have to be bottoming out. Just because prices have come down a lot is never a good reason to expect prices to bounce higher. Now, bond prices, the TLT, facing support from March of 2021, totally fair. That's something to look at. But overall, certainly the general trend in this chart is overwhelmingly down. This gap lower is just the latest in the moves. A higher low would tell me that trend is changing, among other things, and we're just not seeing it yet. Just to finish off our big picture discussion here, first, I point out gold prices, oil prices, all of those coming off fairly significantly in the last week. Both of them spiking higher with broad strength in the commodity complex. You're seeing those lighten up a bit. What I would tell you is, overall, similar to where we saw the bear market rallies in the S&P, right? The trend overall is down, but you'll see these little short-term bounces higher that are very quick, very sudden, pop up a little bit, and then the downtrend continues. I would assume this is the kind of thing we're seeing with gold prices. Sort of the bear market rally flipped over. It's sort of a bull market pullback. It's a pullback within an uptrend. Again, the concerning development on this chart would be a lower high. If we fail to eclipse the previous highs, which is this gap higher, it's above 192 that we saw last week. So that's what I'd be looking for. Can we cement in a higher low? 180 could be an interesting point on the GLD. For support, that would be a Fibonacci level based back on the range from 2020 to 2021. Let's continue on to our next segment, sector setups. We talked about the big picture. Stock prices are going down. We know that. Fed meeting this week, and rates are starting to accelerate to the upside. Rate hike is something to be thinking through, and what those potential, what that one might mean for different sectors. Looking at sector rotation or sector returns today, financials the number one sector, and I think we've seen that pretty regularly. It feels like energy and financials have been sort of barbells on this market, either up significantly or down significantly. Financials by far the biggest winner today. Then you have healthcare and consumer staples. And what's interesting about that is I'm going to look at this graphic here. If you look at sector returns year to date, and one of the ways to do that is if you go to charts and tools. There's where do we look at? I looked at sector summary. That might be a better way to do this. But at the bottom, this says sector perf chart. It's a really good, just quick visual on how these different sectors are moving relative to one another. I'm right clicking on the date range and making them year to date. So this is just year to date returns. And I'm looking at the actual returns here. So what we can see is the energy sector. Hold on a second. Here we go. Relative returns. So I was going to say I wanted to make it relative to the S&P. So what I've done is basically say the S&P is at the zero line, and then how have these sectors outperformed or underperformed? How have they performed relative to the S&P? So on a relative basis, the energy sector is up 50% year to date. Meaning, if you own the XLE, you've outperformed the S&P by over 50% just in the first month and a week of 2022, which is absolutely insane but true. Second to that, which might be a surprise, is utilities, which is actually up on a relative basis just over 10%. After that, you have a couple of these very, very close. Financials up 5%, industrials and staples both up over 4%, and then healthcare 3%. Everything else is sort of flat to down. And on a relative basis, you can see the biggest underperformers are the growth stocks, right? They're growth sectors, consumer discretionary, technology, communication services. And what happens here on the perf chart, by the way, is if you click on one of the tickers, it standardizes everything to that ticker. So it's a great way to look at relative returns very quickly. What I wanted to show you is below there. This is Sam Stovall's sector rotation model, and it shows you what sectors tend to lead and what tend to lag in different parts of the market cycle. Now, the blue is sort of the business cycle. The orange is the market cycle. So assume that this is an idealized pattern of the S&P 500. You have the market top here, you have the downtrend, the bear market phase, the market bottom here on the left side, and then the bull market phase. You see where the market's bottoming out and starting to do well. Technology, consumer discretionary tend to be leading. As the bull market continues, you get further strength from industrials, communication services, materials. Energy tends to be late cycle leadership. So when we talk about the cyclicals, industrials, materials, and energy, those tend to do the best when we're getting to the end of the bull market phase, which is one of the concerning parts of the fact that energy's done so well. Is that usually tends to happen when the market's topping out. As you look, this is what's actually playing out. So what's next? If we are in a bear market phase and energy may be starting to step away from the leadership role, what's going to tend to do well? It's this next group of three sectors: consumer staples, healthcare, and utilities. And what concerns me is, as I mentioned, after energy and financials, you had those three sectors of sort of that next group of sectors doing pretty well. When I'm screening for stocks making new swing highs and new swing lows, I'm finding a lot of names within consumer staples, within healthcare, and even within utilities, REITs, and others. These are fairly defensive sectors that are where institutions certainly tend to rotate during a bear market phase. It's a way to hide out when the markets are starting to struggle a little bit. So that's the idealized sector rotation model. Might be an interesting thing to take a look at if you're not familiar with what tends to lead at different parts of the cycle. Let's look at Julius de Kempener's RRG. This is the relative rotation graph. And you can see the how these sectors are performing relative to one another. By the way, just wanted to mention it very quickly. I'm going to be doing a presentation at the Money Show Virtual Expo next week with Julius. I think it's next Wednesday. But if you go to stockcharts.com/money show, you can sign up for that upcoming event. So here we see, using the weekly data, the energy sector, the strongest performer up and to the right, and it's clearly the outlier. It's sort of energy and everything else. And you saw Relative returns year to date, energy outperforming by over 50%, and that is clearly the outlier. And it's in unusual circumstances with the military action in the Ukraine and all of the potential ripple effects that are happening. Results certainly elevating oil prices and energy benefiting a great deal from that tailwind. What's after energy, right? What's really starting to emerge? Consumer staples, the second strongest, but you can see it's heading sort of southeast. So that's still okay because further to the right means it's outperforming, but the momentum is actually slowing up a little bit. This is utilities right here, which is actually really starting to emerge in a position of strength. What's cool about the RG is we can go back to the market peak in January and start to fast forward. You can see there how energy just explodes up and to the right. We'll go back again. And then I want you to focus on utilities over here, which is in the improving quadrant, starting to lighten up and now rotating back. And so that's probably the second strongest after energy in terms of the overall trend and momentum of a sector. I would point there number two. After that, probably healthcare and industrials, which would be these next two down here. So overall, you're seeing some strength. Seeing some strength there. You're seeing weakness in technology and consumer discretionary. Let's look at the same period. You can see how these had been okay, doing well toward the end of last year, but look at how both of those, this is consumer discretionary and technology, continuing to push to the downside. Now, the only two remaining in the lagging quadrants. This still very much speaks of value over growth, given the rising rate environment, given what the Fed is most likely doing here this week and weeks and months to come. I would argue value over growth certainly seems like a decent investment thesis to be focusing on. We need to take a quick commercial break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. A couple quick announcements before we get to our next segment. First off, we welcome your questions. We'll do another mailbag segment on tomorrow's show, Tuesday of this week, and we'd love to answer one of yours live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours in our next mailbag segment on Tuesday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. It's completely free. There's so much great content on there. Special guests like the ones that we bring through this show every week. Special events like the Pitch, Chart Madness, our Market Outlook specials, and so much more. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. Our next segment is called Shifting Stocks. This completes our three-pronged approach to market analysis, starting big picture, talking about the continued deterioration in stocks, looking at sector rotation and some of the emerging strength in the relative performance of fairly defensive sectors. Now we're going to get to some individual names. Before we do that, though, I wanted to mention during the break, I was remembering one other thing I wanted to mention about sectors. Two sectors made a new 6-month plus low. Two sectors today made a closing low for a new low for 2022. That's communication services, which again, if you're looking for an indication of a changed market, look at this sector chart in the first 2/3 from March 2020 to September 21, and then look at the right third of the chart as that trend just completely shifts from uptrend to downtrend. Just this and the 50-day tells you all you need to know about the change of character from one to the other, and the relative strength continuing to go down, making a new multi-year relative low today is certainly a cause for concern. This is technology as well, breaking down. You could argue this is a big head and shoulders like pattern. It's sort of a strange shaped head and shoulder, not an ideal pattern, but certainly good enough, I would argue, for what we think about. If we take the high from December, the shorter highs in September and February, those are your two shoulders. The neckline would be the October low and the January low. We broke down through that, I think, on Friday and validated that with a breakdown today. That measures a lot lower. That actually goes down to maybe 115, 110 or so, which would take us down to a 61.8% retracement. That would take us down in the ballpark of the September October 2020 range. That could put the S&P down to 3,800 or so if you get that sort of move in technology. So my point of showing those two charts is within the growth space, I'm seeing continued weakness. And again, they could bottom today. I don't, or today could be the low for the year. I have no idea. But I will tell you is based on the best practices of technical analysis. These are charts in a downtrend. I'd much rather wait for an indication of bullish sentiment. We're not seeing that yet. To continue that theme, let's look at some of the individual names that comprise those sectors. We'll start with communication services. We have Netflix, and we'll talk about tech as well. Here's Netflix. Right? And we've talked about these FANG charts. The two weakest of the six fan mag names, Netflix and Meta Platforms, both within communication services. Netflix closed to a new closing low for the year on Friday, closing around 340, down almost another 10 points today, almost 3%. So continuing lower. So, again, if you're looking for stability from the FANG stocks that would indicate an exhaustion of selling, I'm not seeing that yet. I'm seeing signs of further deterioration. Apple is a tough chart, and I put a video on my YouTube channel end of last week about this chart. I'd encourage you to check that out. My channel is called Market Misbehavior, and the most recent video was on this particular chart. And we looked at the chart of Apple and why 155 is so significant. 155 was the high from last September. It was also the low from January, and also the low from February, and also the low from mid March. And that's not true. We actually traded below there to the 200-day in February, but didn't close below that 155 level. As of Friday, we closed almost right at it. And my point was, we're really close to this chart going from remaining stable and holding support to failing to hold support and indicating the next leg lower. And I would argue today we're sort of seeing that follow through. Apple's now below its 200-day moving average and is closed below it for the first time since April 2020. This is a significant change for a stock that in general has been a great leadership play. So you can see on a relative basis, we're making a new 3-month relative low today. So you're starting to see rotation even away from the more defensive, the most stable blue chip parts of the technology space. And I think that is a warning of further deterioration to come. So what's working? Well, two sectors we'll look at: consumer staples and healthcare. And again, given a bear market phase, which I would argue that we are clearly in, what sectors tend to do well in that sort of environment? Defensive stuff like consumer staples and sector like healthcare as well. If you look, a lot of these names that we talk about, the relative strength line at the bottom is an important one to focus on. Look at how pretty much all of these are showing improved relative strength, which means even if the price performance isn't ideal, it's not shooting the lights out. Overall, it's not going down at a time when a lot of individual stocks are, and that's why it tends to be a good place to hide out, particularly in consumer staples. You tend to have a decent dividend component that you may be able to rely on as well. Kraft Heinz is an interesting chart here, KHC, and we're actually going to unadjust it. When you're dealing with something that pays a fairly decent dividend, a lot of times unadjusting the data can be helpful, because what we normally do is we adjust the price data for dividends. So anytime a stock pays a dividend, you get a little gap on the chart. We adjust for those so that our technical indicators are based purely on investor behavior. But if you're looking at support and resistance levels, put the little underscore before the ticker, and it can be a better way of analyzing the price, because this is what price the stock actually traded at if you look back at some particularly historical date. We're not adjusting the data as all. When you do that on Kraft Heinz, you can see we have broken above the 200-day moving average. You can see resistance around 38, we'll call it, on in November of last year. In January of this year was finally broken above in February. We tested that from above, and now we're sort of right at that level. So we're sitting on a previous resistance level and sitting at the 200-day. This could be setting up for the next move higher on Kraft Heinz. That's why I think it's an interesting chart, starting to outperform but pulling back a little bit in the short term. Big box retailers really starting to emerge pretty well. Walmart, on an absolute basis, has been a sideways chart by any definition. So it's not my favorite chart on an absolute basis, but on a relative basis, it's a really good place to be. Look at how the relative strength is improving. And what that means is these are stocks that are holding up when other stocks are struggling. Same with Costco. Really, for the last year, this has been a good chart to own on a relative basis. It had pulled back quite a bit in January. The relative strength suffered as the S&P was making new highs, and this started to come off. But look at how it's regained some of that magic, while the S&P has been trending downwards. That's where the relative strength is improving. Holding the 50-day moving average for Costco could be really helpful. Coca-Cola is another one, again, coming off of all-time highs. What concerns me about the chart of Coke is the bearish momentum divergence. You have higher highs January, February, early March, lower peaks and momentum. So that's probably not my favorite chart, but I'm very keen to see if it's able to hold support here. And really, I think you have room down to around 56. And let's actually unadjust this as well, because that can be a better way to look at support levels. Here we go. So if you're looking at the high from July, August of last year, lines up pretty well around 57 with the high from November of last year. That's actually the pullback in December. And now we're right back to those levels from above. The 200-day moving average is really close. So similar to KHC, I think Coca is another one that could be in a position of strength, pulling back to a reasonable support level. And that could be a really interesting entry point, assuming another leg higher. Just to finish off within healthcare, DexCom, one of the better performing stocks today. This is up 4%, but worth noting, this is coming off of a fairly beaten down level. Just like Coke that we were just looking at with the bearish momentum divergence, flip that over, and you have the bullish momentum divergence on DXCM. You have a lower close January into February, higher RSI if you look January into February. If we look at the candle patterns, which is not that button, here we go, candle focus, you can see a really interesting candle here. This was in the last week in February. You have what's called a bullish engulfing pattern, a downtrend, a big down candle, a lower open. The close, therefore, engulfs the range of the first day. That's a bullish pattern that continued. You had a bearish engulfing pattern here that played out. Today, you actually have what's called a bullish piercing line. If you want to look up your candle terminology, that's where you have a down day. Instead of being an engulfing pattern, it gets at least 50% up. It doesn't make it all the way above yesterday's open. That's still a bullish candle, and I think that sets up for potential further upside on DexCom. I'd also point out ABBV, one of the stronger stocks anywhere in the market, but continuing to push to the upside. Johnny John, JNJ, testing the upper levels of resistance. I'd be looking to see if that can continue to improve. And again, these are stocks with improving relative strength. Those are good stocks to be paying attention to. We need to wrap the show, folks. Go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number one is looking at the TLT, the long bond ETF. In our market recap, we talked about bond prices coming down. We talked about interest rates going higher. Again, we have the Fed meeting this week, the first of potentially numerous rate hikes over the next couple of years. Certainly a theme, a main theme we will all be having to deal with. What's interesting about the chart of the TLT is it's now round tripped from going the lows in March of 2021 around 131, going to a high in the 150s at the end of last year, but now going all the way back down to the lows. Just because it's gotten to the bottom of the page is not a good reason why I would want to buy that. Looking for stability, looking for the stock or the ETF finding support would be more meaningful. Chart number two, gold. Right, we talk about inflation. That has been certainly an important theme, but more and more investors and consumers are recognizing the impacts of inflation on consumer behavior, on the consumer discretionary sector and other discretionary purchases, and what that means for the market as a whole. What's interesting is gold is usually thought of as a good inflation hedge. You saw a big move higher in gold prices in February into the first week in March. Over the last week, though, you're seeing gold prices come off. Now, that's after an acceleration to the upside, cooling off a little bit. Same with oil prices. I would argue, I think stronger commodities over time still make a lot of sense, but I think coming off of overextended levels is what we're experiencing here this week. Finally, the healthcare sectors. I showed you the sort of idealized market cycle and the business cycle. What sectors tend to lead and outperform during different parts of the market cycle? If we are in a bear market phase, that would indicate the end of growth leadership, which we have absolutely seen. It would mean the end of energy really dominating, which is potentially what we're seeing, but certainly has had a really good run. And it should start to we start to look at a couple other sectors like consumer staples, like utilities, and healthcare. And we picked out some of the names in those in some of those sectors that are holding up pretty well. And again, the relative strength on a chart like healthcare shows you, I think, much of what you need to know about what sectors to be focused on. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the Final Bar. As a reminder, all of our previous episodes, including some fantastic interviews, all on demand for free at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.